Today I'm going to talk about investment returns and risk, and I suspect that this video might ruffle a few feathers, so hey, drop me a like if you find this video useful, and also don't forget to subscribe to my Telegram group for more updates and great deals. Now I'm going to start by putting a risk-return graph here to remind everyone of a few things. When someone tells you that a return of a particular investment is great, it usually means that the risk goes up correspondingly. There is no free lunch in the world, or is there? Based on my personal observation, there are actually times where risk and return deviate from their relationship. So let's take a look at some instances where this happened. Now, this video is entirely based on my own observations, so do not take this as financial advice. You do not share any of your profits with me, so I am also not responsible for any losses you incur. The first example I can think of where risk and returns deviate is when companies throw marketing dollars to entice users. Over the past couple of years, we have seen all kinds of animal apps giving generous sign-up rewards when you invest with them. Usually, you are able to invest in relatively low-risk stuff, even money market funds. Now, there are people who are entirely uncomfortable with the concept of investments, preferring to put their money into banks instead. But the risk level of an investment largely lies in the underlying asset one is invested in. When we look at money market funds, some of these are basically invested in fixed deposit of banks. In fact, more often than not, they are invested in fixed deposits of multiple banks. In this case, putting funds into such funds may actually be safer than putting all your funds in a single bank, since to lose all your money, you will need all the banks to collapse, versus a single bank failing. Of course, you get SDIC coverage when you put funds in a single bank, so I'm not saying that it's a high risk thing, just that a fund invested in multiple bank deposits isn't as scary as it sounds, even if it's technically an investment. So how do these animal apps actually give attractive promos and guaranteed returns? My observation is that these come from their marketing budgets. Thus, your risk actually remains that of a money market fund, but the returns are skewed upwards, at least for a while. Usually, these are time limited and only applicable to new users, so the company loses money acquiring you as a customer, as many other companies tend to do, like credit cards offering generous sign-up bonuses when you sign up. Now, full disclosure, this video is brought to you by one of these apps, so let's take a look at what they're offering before we come back to the video. This video is brought to you by Weeboo, and new users can get up to 7% Moneybull interest for up to 180 days with return of up to 3,500 USD. Moneybull is open to all Weeboo accounts in June for you to access easily. Previously, it was only applicable to margin accounts. The 3,500 USD Moneybull U is based on 100,000 USD subscription of USD Moneybull. The 7% Moneybull interest only applies to the first 100,000 USD of USD Moneybull subscription. Additionally, for those who want to trade, you can deposit 2,000 USD, complete 3 US buy trades, and maintain until 31st July to get USD $80 cash vouchers. If you deposit 10,000 USD and complete 5 US buy trades and maintain to the same 31st July 2024, you can get USD $400 in cash vouchers. If you're looking to invest in the US market, consider switching to Weeboo. Known for its low trading fees, intuitive interface, and powerful tools, Weeboo could be your ideal trading platform. Additionally, Weeboo's latest transfer-in promo provides attractive rewards for both new and existing users who haven't transferred shares to Weeboo before. For new and existing users who have yet to transfer in shares to Weeboo before, you can enjoy these attractive rewards when you meet the following requirements. So sign up now and get your perks. Thanks for signing up and supporting this channel. Another interesting thing that I want to put on this graph will be Chocolate Finance, and for those who have not heard of this startup before, it is a fintech startup that offers a product that currently guarantees you 4.2% per annum returns on the first $20,000 you place with them. The money goes into funds, and from what the app tells me, they are Dimensional Global Short-Term Investment Grade Fixed Income Fund, Fullerton Short-Term Interest Rate Fund, and UBAM United SGD Fund. Now these funds are now buying bonds, which are riskier than bank deposits, but from what I can tell, these funds are largely buying short-term bonds with big reputable companies, which means that the risk level is not super duper high. For riskier than bank deposits, we can get a potentially higher return. Now remember that Chocolate Finance guarantees you 4.2% per annum return. This is because they expect the funds to do better than that and would hence pocket the difference to make their money. If the funds do perform well, you get 4.2% per annum returns, which means that your returns have been reduced. But at the same time, if they don't do that great and underperforms 4.2%, you still get 4.2% per annum, and thus your risk is lower because of this guarantee by Chocolate Finance. Guarantees are only as strong as the entity providing it. There is a difference between being guaranteed by the Singapore government with its massive financial strength and being guaranteed by XYZ country with dubious financials, right? Therefore, when we talk about guaranteed by Chocolate Finance, it also depends on how strong this guarantee is. Now, personally, I feel that in a worst case scenario where Chocolate Finance collapses, the underlying assets are still very diversified and relatively low risk, so I don't lose sleep over losing my capital on this. If they really collapse, I think the only risk is that I lose my 4.2% per annum guarantee, but my money are still in these funds which are relatively not so volatile because of their underlying assets. So I would say that the risk return of this is kind of fair in my opinion, and I personally think that you fall somewhere between buying the underlying funds yourself and bank deposits. Overall, it should be relatively safe, but do take note, they are not bank deposits and are of slightly higher risk profile in my opinion. The product isn't open for public subscription yet, so if you're interested in this, stay subscribed to my Telegram. I hear that updates are coming soon. Of late, there has been increasing interest in this thing called BigFundr, which is an investment platform under Maxi-Cash. Yeah, the pawn shop that we see all over Singapore. Now, like everything else I'm mentioning in this video, this is a licensed and MAS regulated entity, and their pitch is that they offer retail investors access to real estate backed loans, and Maxi-Cash will guarantee returns on both the principal and interest. Now, this sounds a little like chocolate finance, but again, we have to look at underlying assets. BigFundr takes investors' money and pools them to loan them to overseas real estate projects that needs funds. Like any loan, these projects will pay BigFundr an interest, who in turn takes its cut and pay investors a guaranteed yield. This yield is typically around 6% per annum and depends on the specific project BigFundr is releasing. Now, this means that these real estate projects are paying BigFundr much more than 6% per annum in returns for their loans, and this is where I think the risk goes up. Typically, entities with good credit ratings don't have to pay a lot of interest to get loans. Why? Again, risk and return. The Singapore government just needs to pay around 3% per annum, and Singapore Savings Bond is oversubscribed because everyone trusts in the government's ability to repay its loan. If I, Satisfy, wants to borrow money from you, I definitely have to pay more than the Singapore government to borrow money from you, right? Risk and return. Therefore, I think it bears the question why these real estate projects need to pay high interest to BigFundr to borrow money. Now, BigFundr does try to mitigate risk in a few ways, like lending a maximum of 70% of the property value and making the borrower entity commit to a personal guarantee. But in the event the borrower does not pay back the loan, Maxi-Cash is itself going to guarantee your capital as well as interest. So in a way, the risk has come down versus lending the real estate project directly, but of course your returns also goes down. An analogy that I can think of would be a friend's friend needs a loan and your friend is asking you to lend his friend money. He says, don't worry, he has signed an IOU and I'm not lending him too much money. If he runs away, I will pay you back. Now effectively, the question now becomes whether you trust this friend of yours or not. And if you do, by all means, lend him the money. Oh, and by the way, your friend is earning from this arrangement because he's charging your friend higher interest than the interest that you're charging him for this loan. So personally, I'm seeing BigFundr as whether I'm willing to lend Maxi-Cash at around 6% per annum. And you know what? I don't think I would. Maxi-Cash has issued bonds before around this return, and nobody was really talking about it last time because companies issue bonds all the time. But hey, when you package it into something called BigFundr, it looks like a compelling investment. But at the end of the day, it feels a lot like lending a single company money, and I personally do not like to buy bonds or shares of individual companies. Now, I'm not saying that this is a terrible investment, but do be aware of the risk-return trade-off if you choose to go into it. And hey, if you do want to invest in BigFundr, use my referral code to keep me making more videos, and you also get some sign-up incentives yourself. Check out the description box for more details. Finally, I want to talk about investment-linked policies. Now, ILPs come in many shapes and sizes, and there are things like Snack, which risk is that of an Asian fund, and I would say not super low because it's focused only on one region. So if Asia does well, you get great returns from this, and of course the reverse is true as well. But the promos that Snack has been giving skew the returns upwards. This is why I talked about it in my Telegram channel last year when the promo was super duper good. Seems like their marketing budget has been used up though, cause the latest promo this month is kinda not that interesting. In any case, Snack isn't really the type of ILP being sold in the market right now. I'm more referring to ILPs that are often sold by agents. You know, the kind that come with bonus units but also has lengthy lock-in periods, so you lose your capital if you terminate early. I've talked a lot about ILPs in previous videos, so I'm going to link to those instead of repeating things here. But the long and short of it is that high fees actually skew your returns down for the same risk level. When we invest in low risk things, we accept the lower returns, and if we want potentially higher returns, we have to accept higher risk. In the case of many ILPs, the reason why I'm so against them is because I view them as getting returns that are just not proportional to the risk that we are taking. There are three main things responsible for this, and one is the high upfront commissions paid to the agent, number two, the fees paid to the insurer itself, and three, the ongoing fees paid to the underlying funds. Now all of these are transparent and in your policy contract, if you can understand it, and to justify and overcome the high cost paid to the insurer and agent and give you a return over time, the funds need to perform very well, And funds that position themselves as being able to do well and beat the market often also charge high fees and are of higher risk profile. But in recent years, one of the more popular funds being pushed for its high returns just isn't doing so great. Now, don't get me wrong, I'm not saying that there's anything wrong with pursuing a higher risk investment strategy. It's just that I feel like buyers of ILPs are not appropriately rewarded for the higher risk they take because of the high costs involved. In theory, the bonus unit should skew returns up, but in practice, they really just alleviate some of the high upfront costs in the ILPs. A telltale sign of this not being an actual free gift is that you actually lose money when you terminate such products early. When it comes to actual free gifts of things like credit cards, trading apps, or even snack, right, is that you can try out the product, and if you really don't like it, you can often walk away without having to pay termination fees. You can sell your investment at the prevailing market rate and keep the free gift entirely. Those are really free gifts, whereas ILP bonus units are something I've talked about in previous video where if you terminate early, you actually lose your capital. So is that really a free gift when there's so many strings attached? Now, at the end of the day, whether you're a risk-averse investor or someone who's willing to be a bit more adventurous for more gain, I hope that this video has been useful to help you make choices more wisely. It's not financial advice tailored to your personal circumstances, of course, but I hope that it has been at least useful for you to weigh between risk and return whenever you're making an investment. Now remember to subscribe to my Telegram group for more content and great deals, and check out this video where I talk more about my entire investment portfolio. It's a bit outdated now, but hey, stay tuned for updates.